Okay, welcome back to these Monday Minutes. Right now, we're doing a two-part series comparing 2001 to 2008 to 2020. And this is the second part of the two-part series. So if you haven't yet listened to the first part where we talk about both 2001 and 2008, make sure to go back and do that, because today we're going to talk about 2020, which in particular is about the concerns around and the virus itself, coronavirus. Now, if you're listening to this in real time, you know that we're in the midst of a very serious economic situation, the likes of which I certainly don't have any personal experience with, nor do most of the people that are alive right now. And before we jump into some of this data, I want to make it clear that economists tend to establish that we're only in a recession once there has been 2 quarters of negative economic growth. Now, you can claim, I believe we're currently in a recession, but you don't technically know it until those quarters of economic growth, negative economic growth, I should say, have happened. So I'm not sure what the exact correct terminology is. I'm not a trained economist, but I think you get where I'm going with this. We're definitely in a wild time. Now, the reason I'm saying this is that if that's your definition of a recession, which is 2 quarters of negative economic growth, I know that's not everyone's, but let's just use that since it's very common. We're definitely on the brink of what I would consider to be upwards of 95% plus chance that we're going to have at least 1 quarter of negative economic growth. I mean, it's hard to say 100%, but it's up there. And from my perspective, and this is getting more speculative, of course, I would say it's in the 85 to 90 plus percent that we'd have at least 2 quarters of negative economic growth. Now, that's under the assumption that we don't really deal with the whole pandemic issue. For example, if the nation of the United States had a situation similar to what's going on in Manhattan, New York, for example, it would be very bad. Very hard for me to speculate on that. So that's basically if things go the way they look like they're going to go, and it's just the shelter in place that likely causes a recession, I think that we do have 2 quarters of negative economic growth as I don't want to say best case scenario, but a likely outcome. Now, real estate tends to lag in a lot of ways. The first of which is that people don't really need to pay rent until the beginning of the next month. Now, as the recording of this, we've had one time where people have actually had to pay rent, but it hasn't really even been a full month. April 1st was the date that I'm referring to. So far, the data that we've gotten back from the sponsors we work with in multifamily, which I think is probably the most important, or at least most telling, as opposed to retail, which is in a total standstill, which we'll talk about in a moment, and self-storage, which is relatively unaffected. Basically, the sponsors have suggested that things have been okay so far, not quite as bad as they anticipated. They're much more interested in the May number and how things are playing out until we get to May. All of them are working to create some sort of flexibility in terms of their tenants paying rent, especially those that have been negatively impacted by COVID-19, which, by the way, is pretty much 100% of everyone. Now, as far as transactions, things have basically been put on pause to a large degree. Everyone is bracing for the unknown, or at least they're waiting for a few positive data points to come out before making a decision to move forward with the purchase and sale agreement. Now, because real estate lags, we frequently look to the public markets for guidance. Now, the public markets, despite all of their challenges and all of my challenges with the stock market, they do tend to give us some useful information about where a lot of the market makers, some of the smartest people in the world, believe this is going to play out. So to put things in perspective, we recently had a 28% drop in the stock market, which took place over about a 30-day period. It is one of the largest drops over any 30-day period ever. In fact, March 9th, 2020, the Dow dropped about 7.79%. And that was the second biggest single day decline in US history, the biggest being in 1987. Now, all in all, as of the recording of this, the Dow has fallen from 29,500 to 18,500, and then has now recovered up to 23,000. It seems that the Dow has made a significant bounce off of those lows. Now, will it last? I don't know. Part of me doubts that it will, given the amount of uncertainty in the marketplace. But in all fairness, I did wire money into an E-Trade account. That's right, not from an E-Trade account, but into an E-Trade account and started buying the S&P 500. I purchased about 25% of my total investment amount every week on each Monday in the middle of the day. And I'm doing this again through the S&P 500, through the ETF IVV, which is a competitor to the SPY. It's a little bit cheaper. Now, if you're interested in doing something similar, but you want to be a little bit more speculative, you want to make a bet on America, things turning around, you could look at something travel related. The airlines have been really beaten up. My wife recently invested in Marriott, for example, which has been really beaten up. So those are some more speculative investment opportunities that are being presented. Now, these drops in the stock market are due to a lot of factors. Most importantly, the shelter-in-place orders that are taking place all over the country. People are concerned about the economic shutdown that's taking place. And of course, there are fears about contagion of the actual virus itself. And a lot of these losses took place prior to these jobless claims, which I'm sure some of you are familiar with. In the previous two recessions, we saw jobless claims in the 350,000 range. And then in 2008, we saw almost 700,000 jobless claims. On March 22nd, we saw 3.3 million. And again, that's comparing against just below 700,000 during 2008. Then on April 2nd, we saw 6.6 million. So I've seen a lot of economic graphs in my day, and I can't remember the last time I saw an economic chart that looks the way that the jobless claims number looked. We'll link to that in the show notes page. You can just Google it. You see a relatively smooth line at the bottom of the chart throughout history, and then a spike from 282,000 to 3.3 million to 6.6 million. Now, there's a lot of things that are unique about this particular challenge, one of which is that businesses are emotionally accustomed to, and economically accustomed to, and prepared for typical business cycles. Now, if you have a really serious recession historically, depending on which sector you're in, you could expect to see a 30% reduction in revenue. Maybe if you're in something super cyclical like hotels, you could see a 50% reduction in revenue. Now, what we're not used to seeing and what people are not emotionally or financially prepared for, having your business be paused. I mean, you look at the entire airline industry, a huge sector of the economy, currently 98% decline in passenger travel. There are many retail stores all over the country that are experiencing a 100% reduction in traffic. Just the doors are closed, zero business. So you're going from revenue to no revenue, not a reduction in revenue, not tighten up your belt or whatever, but just there's no business. That's it. There's basically no comp for this, especially when you consider that it's global, it's very widespread. Everything is a question mark. But there's a lot of interesting things about this as well outside of the economic data, one of which is that the mindset is very different. All of this is very specific to concerns around the virus. It isn't shame or guilt or uncertainty that are generally associated with businesses closing as a result of recessions. You just don't know if it was your fault or if it was the overall economy. This situation is very different. To put it another way, let's say that there was a vaccine that was created for COVID-19 that was 100% effective and immediately available. Business would be back to normal in less than 30 days. It would just be turned back on. That is not the way that most recessions work. This is really important because the mindset that goes along with this stuff is critical. When you experience a significant recession and people lose their businesses, they can spend years meandering around trying to find the most efficient place for them to put their time and energy and expertise. So that matters greatly in terms of how this rebound may look. So was this 28% bottom the bottom, or will there be more of a correction? To be honest with you, the fact that the public markets have not tested those lows again is actually something that implies to me that the people that know the most and have the most access to data believe that this is going to resolve itself relatively quickly. Again, you can watch CNN for your information when it comes to the political election of 2016, or if you watch the stock market and you start to see it going crazy, then you knew something was really about to change. I mean, that was a wild, wild example, but the stock market knew before any individual knew, with a high degree of certainty, I would say. Now, here's a question, of course, will there be a correction in real estate? That's what most people are interested in, at least those that listen to the program. It would be very odd. It would be very odd if there was two recessions in a row that led to a significant reduction in real estate. it might happen just given the uncertainty surrounding the income at which commercial properties are traded based on. There's a lot of uncertainty around the reliability of that income, particularly in some asset classes. Will we see the jobless claims level off? We certainly better. This is going to put a massive amount of strain on the federal government and the economy, the likes of which we pretty much haven't seen. Of course, I think that they will once these issues start to be resolved. I don't know the answers to all these questions, but I'm 100% dedicated to staying on top of it, giving you accurate information, because these are the topics that are really going to dictate my own investment strategy, and therefore, I want to share them with you. Very soon, I'm going to do a Monday Minutes on making a decision about how this pandemic is going to play a role in your story. I can tell you that I'm committed to making sure that this program shines in terms of consistently delivering accurate information in a time like this. I can tell from the download numbers that people are intensely paying attention. People are scrambling for answers, especially this audience. I'll give you a pat on the back. In the world of educational content creation, there are frequently cases to be made that you can time the real estate market or time the stock market by just inversely doing what everyone else is doing in terms of content consumption. So if I were to write a book that says how to invest in real estate, and I don't really sell a lot of books, that might be a good time to invest in real estate. But the moment that I start selling a ton of books about how to invest in real estate, you should stop investing in real estate. That is not the case for this audience. This audience is interested when there's massive question marks, because that's the audience that we've created. We're a part of something really special because this show is all about actually getting the answers. So anyway, I wanted to give you kudos for that because I can tell that people are actually interested, that when things get tough, it's not time to fold, it's time to intently pay attention and to proceed with caution like always. So really appreciate it, guys. Hopefully this helped put things in perspective and hope you enjoyed it. All right, listeners, you know the routine. This show is all about learning, making wise investments, and protecting and growing your capital. So if you're interested in these topics, make sure to hit the subscribe button. Of course, if you've already enjoyed a couple of great episodes, don't be shy, leave a review. It really helps the show's visibility. And lastly, if you're an accredited investor and you're interested in learning more about our investment opportunities, the types of deals that I personally invest in, go to asymcapital.com. That's ASYMcapital.com. Thanks a lot.